We're live. Welcome. Coffee with the Johns, Season 3, Episode 6. We are testing out a new studio setup. We're expanding the team a little bit, so we got kicked out of the the other side of the office. And so hopefully, this is a little nicer setup. We got a lot to cover. Inflation officially went down a little bit, and home prices are still going up. So we're gonna
Shocking.
be
Who could have called that?
we're gonna go into some details about that. We're gonna cover actually towards the end. We're gonna cover some strategies and things that we're shifting, especially as far as like the wholesaling goes, reaching out to sellers, what we're doing different in our flip business and our rental business. So we're going to cover those strategies as well, cover some headlines and everything. So if this is your first time joining us, make sure you subscribe. And if you're joining us live, participate, jump in, let us know your thoughts, your questions. If you have anything that you're dealing with in real estate that you would like our opinion or feedback on, any deals, any strategies, anything that you're working on, feel free to drop it in the comments, and we're here to help. Actually that brings up a funny point I wanted to make, and it's one of the things that like we get comments all the time, like in Instagram or TikTok or Facebook, and the comments are always so, oh, if they disagree, you guys are idiots, you're clowns, you don't know what you're talking about. And it's like,
something popped up on TikTok the other
say
day.
something. Like,
on TikTok, and this is like, says the guy doesn't know what he's talking about. I'm like, this is the guy that comments on TikTok, and that's it.
yeah.
Like, all right.
So I try to approach it, because the whole point of this, guys, it's to create dialogue. We're not trying to piss you off, even though recently I've been told that people that watch us, this lady that I know, she calls us Good John and Bad John. So I don't know who she refers to as the Bad John.
I don't know. I couldn't guess.
When
she said John, that, what's your guess? What's your opinion?
She said that, I was like, damn, the Bad John? And she's like, but he's just like nicer. And she's like, it's not that you're bad. I was like, no,
that's exactly
you hurt
what
my
it
feelings
is.
already. But seriously, guys, like we're not here to hurt your feelings or offend you or anything. Like, these are discussions. Like, these are our opinions. We're not saying these are facts. This is just things that we're seeing, things that that we think it is. And if you don't disagree, that is perfectly fine. Let us know what you think. Because we like to have that dialogue. We want to create that dialogue, because it helps not just educate us if we're wrong. It helps educate you. It helps educate other people on the chat that are looking and reading comments. That's the whole goal, is to educate. It's not to offend people. We're not here to just, like, get you guys all riled up. We're here to try to educate you and help you guys out and help ourselves out. Like, if we're wrong on something, I'm more than happy to admit that we're wrong, because all I want to do is be right. You understand? So if you have better information, better data, let us know. Just don't put a comment on there of saying, you guys are idiots. And then when I ask you why, and you just go silent. Like, that's not an argument. You're not really proving the point there. So that was my little tangent. Hopefully, it changes some of your guys' way you comment and approach things.
I wonder who's called the Good John and Bad John after that little tangent. I get so mad at people. The only thing
I don't get mad at people. I just find it to be funny.
Really?
That
Really?
I don't get mad.
Okay, you don't. All right, whatever.
Monks come all the way over here to study me, so it's I don't get mad. That shit just doesn't happen. But how's your week been? Damn, not even our director agrees.
Yeah, he's over there laughing. Week's been good. Week's been good. Went to an event this last weekend in St. Louis with one of our business coaches, which turned out to be very good and eye-opening. It was a lot of fun. Had a hell of a time getting back to San Antonio. I was supposed to originally get back Saturday night at 7 o'clock or 11 o'clock. No, I was supposed to get here at 11 o'clock. And then I started getting notifications throughout the day that my leaving flight was getting delayed and I was going to miss my connecting flight in Dallas. So I call them up. I will give them customer service to American Airlines, give them props, because they're like, how can I what's the process here? And he goes, well, what flight? When do you want to go back? I said, we don't have anything available Sunday, but we can get you back Monday morning. Like, what time do you want to fly? Any time of the day you want to fly? I was like, oh, okay. What are your flights? Picked the 7:40 flight. And then Sunday night, I start getting notifications. Hey, your 7:40 a.m. flight, which I thought was going to be one of the first flights, was not the case, and your flight's going to be delayed. You're going to miss your connecting flight in Dallas. I was like, oh, here we go again. But luckily, it was early enough in the day they were able to push some flights, and I was able to get back later in the day. So I was supposed to get back Saturday night at 11 o'clock. I got back Monday morning at 2 o'clock. So eventually made it back. But overall, the event was a lot of fun. It was great. So
What was the event about?
it's called The Intensive. A lot of things about it's really hard to explain, honestly. Like, it's like you were asking me this, is like until you experience it, like it's hard to like picture.
It was intensive.
It was very intense. There's a lot of things about going into your inner self and your own mind about like, hey, what are your drivers of why you do the things you do? What are your passions in life? What are the things that you are wanting for you? And have some like guided meditations in there to help really dig into your own mind and soul of like what you're looking for and overall happiness, increase your overall happiness in life. So that was what it was about, and it was very good. The two people, it was kind of very yin and yang kind of aspect where you got our coach was one of the people up there, and he's a very Marine style, in your face, kind of like makes you push. And then the other person was very soft and subtle. So they kind of played off each other very well. So if you're interested in that stuff, kind of reach out and we can kind of point you in the right direction. They do it 3 times a year. And I highly suggest anybody that's looking for a breakthrough to kind of push through in their business or their life, highly consider that stuff.
Yeah. The coach's name is Mike Kitko. He's excellent. He's our mindset coach. We hired him how long ago already?
Like May is when we started.
May. So we hired him back in May, and it's we were under the impression from people they told us he's a business coach, and that's what we wanted. And he's really a mindset coach, but that's what we talked about. I was talking to him yesterday, and I was like, see, that's the difference is that like you think you need a business coach, but if you can fix your mindset, your business gets the rewards.
Yeah,
you understand? Because you are the business. As the entrepreneur, as the business owner, you are the business. So if you can fix your mindset, then you fix and grow your business. Because now, that's the stuff. We hired a coach for real estate as well. And we're looking at his business model and everything. And we're like, it's not hard what he does. But what's different is his mindset. He has a different mindset that is allowing him to make $2+ million so far this year doing all kinds of weird ass real estate, right? That's like, it's not hard what he's doing, but he has a different mindset than we do. Yeah. So it's
very simple. Where Mike even says like, I set out to be a mindset coach. When I find out when people fix their minds, their businesses grow.
Exactly. Very crazy coincidence there. So definitely I recommend everybody check him out. And actually, I wanted to kind of touch on that topic then, being that we're on it, but that's the stuff that we talked about before, you and I don't know if we talked about it on the show, but this past year has been really, really good for us, in real estate business wise. And instead of going out and, spending it on luxury vehicles or crazy vacations or stuff like that, what we did is we doubled down on education, right? We hired coaches, we hired trainers, we both for business, for real estate, for mindset. Because that's how we look at the economy. When the economy is really good, that's when you use to invest in yourself, invest in your business.
That's the thing I said, or I took it from somebody else. They said there's only bad times and preparing for bad times.
Right.
It's like there's no such thing as good times. Like it's the bad times that really devastate and destroy people, or the people that like PBD puts about. That's when people add zeros to their net worth.
Exactly.
So it's preparing. Like when times are good, it's preparing for the next downturn to do that. So everyone usually just rides the wave of the economy, and whatever happens. Like, well, no, when things are good, stockpile some cash, be ready, education, learn when things go down. Enjoy yourself for sure, but if you prepare for the bad times, you can still enjoy yourself, and that's in those rough times.
Also, that's why we are not worried about the coming recession, or if it turns into a depression, or if it doesn't do anything. Like it doesn't matter to us as much because we're prepared for whatever comes down the road. That's what we're doing. We're always preparing for worst case scenario. Even in our investing, every time we bought a deal, what's the first analysis that we do? If everything goes wrong and we're off on the rehab, we don't sell for as much and everything, are we still okay?
Well,
Right? Like you always hedge for the worst. And then, because you don't have to prepare for the best is the best. It's going to happen. You're going to be, you're going to enjoy it when that shit happens. But the problem is when the worst happens, you don't know what the hell to do. You're not ready.
Oh, for sure. And that's where one thing our real estate coach, and like he put it out there and he mentioned it, where he said, don't think about it as your profit margin. Think about it as your margin of safety. Like, what is your margin of safety before you start losing money? And when he said it that way, I'm like, I like looking at it that way much better than saying, oh, how much profit you got built in the thing. It's like, not how much profit I got built. It's how big a margin of safety do I have before I have to come out of pocket to sell the house, sell the property, whatever it may be.
Mm-hmm.
So that's something that's very interesting to look at it that way. Is like, look at it as a margin of safety, not as a profit margin.
Yeah. So if it's your first time joining us, make sure you subscribe and give us a thumbs up if you're enjoying the conversation. Like I said, we're going to be covering topics on real estate, the market, what we're seeing with trends in the market, some strategies. So it's going to be a fun show. Make sure you jump in the comment section. Let us know any questions and concerns or things that you're dealing with, and we'll answer them live and help you guys out. So you had a topic you wanted to start with that you were really proud about. So
yeah. Oh, it's just always so people always talk about like, oh, this city's got the best barbecue. This city's got the Kansas City barbecue, and oh, Texas barbecue, and all this other stuff. And then when you got the arguments between Austin's got better, Dallas, San Antonio. Well, San Antonio, home city, just was listed as the #1 best barbecue place in the country by Clever magazine or website. I'm not sure what they use. A listicle site named Clever used 2022 data to rank San Antonio #1 amongst the best barbecue sites across the country. Yes, San Antonio beat out all the self-claimed barbecue capitals of Texas and even the world. Right, proud, baby, right there. Even though you don't like barbecue because you're weird. San Antonio got praised for its low prices, number of barbecue restaurants. They had to have they had to have counted Bill Miller's balance of quality. Although I say like I can't do fast food barbecue, balance of quality and quantity, as well as hunger for brisket. The city was also recognized for its number of major barbecue competitions and events. Because what can we say? We love a good cook-off. Those barbecue cook-offs are pretty sweet because then you can just try everyone's different barbecue, different sauces, different styles, different everything.
So this magazine that has anybody ever heard of this man? Is it like a San Antonio magazine?
No, it's not.
Are they actually known magazine?
Yeah, they are.
Okay. I don't know. Barbecue, I tried it when I moved down here. I've tried it quite a few times.
Yeah, but you just like meat
I don't
and salt
understand.
and pepper, and that's it.
I just don't understand when you cook a meat and then you have to drench it in sauce because it has no flavor. To me, it's like I'm just eating sauce at this point. Like,
you're a very simple person when it comes to eating
because I like
meat.
flavor. If I need to douse something in sauce, then you fucked up.
That's a flavor.
Okay.
It's like when you take brisket and smoke it, and then you can have dry rubs. You can have
I do want to give a shout out to Will Pritchett. He is the only person. He doesn't have a barbecue joint, which in my opinion he should. But he's the only person that's made barbecue that I enjoyed the hell out of.
That's what I said. That's why they say the cook-off places. You get into the smaller like joint stuff. You go to the big production style. Yeah, they're gonna douse them in sauce and stuff like that. That's why I don't go to Bill Miller's. Like you can't have fast food barbecue. But you go to places like Rudy's and get their stuff. It's not doused in sauce. You can douse it in sauce. Big Bibs, same thing. I was like, you gotta go to smaller little joints like that.
So this magazine
trying to like make him expand
this magazine is ran by John Barr. So little bias there. Well, let's get into some actual economic news. So inflation falls in July, but housing prices keep rising. So this was an article in Housing Wire, and if you guys want access to all the articles and everything, we're gonna put them in the show notes after we go live. You can read them yourself, look at the stats. I always recommend everybody do your own research because I can read an article, interpret it one way, and then you read it and interpret it a completely different way. So obviously you should go with the way I interpret it. But it's definitely do your own research.
Bad John giving his plug.
Bad John stepping in. That's right. I'm stepping into my role of the Bad John for real.
I'm right.
You guys wanted Bad John.
No
He's here.
No opinion. It's
Bad
me.
John is here.
Bad John.
Thanks,
here.
Luce. All right. So the most significant part of this article was Michelle Bowman. She's a member of the Board of Governors for the Federal Reserve. She says, I see a significant risk of high inflation into next year for necessities including food, housing, fuel, and vehicle. Rents have grown dramatically, and while home sales have slowed, the continued increasing price of single-family homes indicate to me that rents won't decline anytime in the future. Recently, gasoline prices have moderated, but are still roughly 80% higher than pre-pandemic levels due to the constrained domestic supply and the distribution of world markets. So this is why I found this section the most important out of the whole article, is because inflation went down a little bit and went from 9.1 to like 8.5, around there, 8.4.
Yeah, and it went lower than they thought.
Yeah. Yeah.
The prediction was 8.7.
The results being lower or higher than they thought is just a rule of thumb. Like, they're always off. But anyway, so it went down, not a crazy amount, but it went down. But this is the point that she makes, is the point that I look at, is inflation went down, and it's mostly due because of gas prices going down. That is the biggest drop, the biggest contributor to inflation dropping as much as it did. Is oil went down drastically. It was like closing in on like 115, 120 a barrel, and now it's down to like 90. So that was a big concern. That was a big factor for the drop of an inflation of the inflation amount. But when you look at everything else, food, housing, vehicles, we were talking about like new cars and everything. Like now, $1,000 car payment is kind of the norm.
That's
it's
oh
nuts.
My God.
So and food prices, everything, all those things aren't dropping. So when they say inflation went down a little bit, yeah, but nothing's really happened. Like it's not, it doesn't do anything. Like, what are your opinions? Do you think the Fed is going to ease up with interest rates because inflation went down a little bit? Do you think they're going to keep raising them because it's definitely not where they want it to be? Like, what are your thoughts?
That's a very hard thing to do because they talk a big game, and it's still the same thing. It's like they're trying to slow the market down by saying they're going to do a lot of things, and so they don't have to because they know how bad, like how long it takes when they reverse course. It's the same thing. They raise by 3/4 a point, half a point, and it's another month that comes around before they do it. The next meeting isn't until September, so they're skipping August. Well, they have 2 months of data to really determine should we raise again, because it's a very long lag time to get this stuff to really have an impact.
Mm-hmm.
So the same thing, it's like if we keep rising and they overshoot to get it to cool down, it takes a minute to pull that brake back off. It's not like, hey, it's a gas pedal brake, or you can jump back and forth between the two. It's really, they got to ease it on and then they got to ease it off, and it's just kind of a yo-yo effect back and forth. So I don't know. And I listened to a podcast that a friend sent to me by George Gammon, and I honestly got thoroughly confused the way he looked at it. But he'll
confuse you.
Yeah, he started going, I'm like, okay. And then he started talking, I'm like, I am lost. I'm completely lost what you're talking about. But his overall point that I caught is that the treasury market he said, the way, I don't know how he came to this conclusion, but he said when he was reading it and talking to people, that the market, the way the treasuries were working in the open market and trading, is pricing that the Fed's going to reverse course.
Right.
And it's kind of like, I don't know how you come to that conclusion, but like, what do I think they're going to do? It's like, I really don't know. And I can't say like I don't care, but it's also the thing. It's like I'm going to react to whatever reacts. Like, is it going to go here? Is it going to go there? Like, I don't know. I don't think we're gonna have a huge lending crisis like we had in 2008 ever again, or not ever again, but this time around. So it's something that a friend of ours said. He knew somebody that was buying stuff in San Francisco in 2007, 8, or 9. He's buying it foreclosure and reselling market, and basically followed the market down.
Yeah.
So that's something we've honestly started been doing. Like, hey, it's like if prices start to drop, then we're just gonna buy lower.
You right there?
Well,
Struggling with that mic?
Well, like I turn it towards me, and it's like,
Yeah. You're going to have to tighten it.
yeah, I know.
All right.
But I don't know what's gonna happen.
Yeah,
But
no.
for our business,
And
it's
I
like
mean,
I'm going to follow it on the way down. It's like we've already started looking at things like, hey, if prices started normalizing, but it's why we track the things that we track
Exactly.
and the price points that we're in. The market update that I put out last week, and I just ran some of the numbers for what I'm doing for Stepstone here at noon today. And those numbers look at it. It's like, hey, inventory's rising, but where is it rising? In the higher price point places. Median price and below, inventory's like it's still holding strong as far as like super in demand housing for your median starter home kind of stuff.
So let's actually unpack that a little bit, because that you send a screenshot of that, and I found it extremely interesting. These are the things that we talk about investors when it's like, don't speculate, look at the data, see what the data's telling you, and it doesn't mean that you don't invest. Like I actually went to a meetup last week, and I spoke to a few investors, and they're like, "Yeah, I think I'm just gonna wait, until the end of the year to see what happens." And how many times have we heard of people saying the same thing, and the market just passes them by? Because it's like you're waiting for what exactly? Because we don't know what the heck is gonna happen. We don't know if we are going to get a crash. We don't know if they're going to delay it, if they're going to kick the can down the road, if it's going to keep going. And all the time, you're sitting on the sideline waiting and hoping for this magical crash that was supposed to happen freaking 10 years ago, and we're still waiting for it. And it's like,
it's supposed to have happened every year for the past decade.
Exactly. So I look at it and I'm like, you keep waiting. You're still waiting for all this. And the whole time, you're losing out on a market that you could be making money on.
I look at it, it must be nice to have a business that you have to do.
I don't know. I don't know if they do.
Well, it's like, oh, I'm just going to wait and wait and wait. It's like, we can't wait. We operate. This is our full-time business every single day. It's how we make income. That's how we pay our bills, how we feed families.
Yeah.
It's like, I can't just sit around and wait 3 months to see what happens. Like, no, I need to watch what's happening now and make a business decision of what's happening. Because I can't just sit on the sidelines and just wait. It's like, it doesn't work that way. To me, it's just like, you're a real estate investor, but it's kind of like, you're a part-time real estate investor. This isn't full-time business.
No, for sure. But so going back to that screenshot that you sent, what was the price points that you saw had the highest raise, and what was that raise on months of inventory?
I don't remember this specific one, but it was like for San Antonio, our median price is like 330,000.
Right.
And it was like the 450, 500 price points that had the highest rise.
And they from what I remember seeing, they had over 3 months of inventory.
Yeah.
At this point.
Yeah, and I just did it for like the other major metros. And like as you got higher, those months inventory rose. I mean, they're still it's starting to look normal.
Right.
Compared to was like you made that comment, like compare right now to 2019 and where are we? We're still under 2019 numbers, and we had a booming market then.
Mm-hmm.
But people just don't like to digest bad news.
Yeah.
They love the good news, but when it starts getting bad, it's like, oh, God, everything's going to go to crap. Oh, shit, what are we going to do? Inflation's slowing down, but it's still higher than what it normally was 3 years ago.
And at this last networking event, I was talking to a few investors, and they were telling me, like, man, yeah, I don't know, the market's really cooling down, this and that. And like, it didn't hit me until they were all kind of complaining about it. And it hit me that moment. I was like, no, the market is actually normalizing. It's not cooling down. We're not even where the market was when we were investing in 2018, 2019. Like what you're talking about cooling down is we're cooling down from a ridiculously insane hot ass market that we had the last 2 years. Yes, in that relation, it's cooling down. But in the overall, in the last 5 years, we're still in a hot market. Like it's not really doing anything. The problem is that where I see the big issue for a lot of investors is those investors that have come in 2020 and above, right? 2020, 2021, that they just started in this market, because a lot of them think they're geniuses because they've been killing it in
Not
the
necessarily a
market.
genius. They're just used to like those. That it depends on their level of arrogance and who they are. But some people that come in, or they just understand like, oh, this is how the market works, because it's the only thing they have
Right.
reference to, and they don't study and ask questions and talk to people that lived through. It's even crazy to say now. Like, go talk to people that survived 2007 and 8. We're doing real estate before and after.
And
Like,
during.
and during, like,
Yeah.
that's who you want to talk with. As like even talk to us, like people like, oh, what was it like before the pandemic?
Mm-hmm.
Like, I mean, yeah, it was very common that you go all out on a house, you put it on the market, and it might be 2, 3, 4 weeks before you get a house.
Yeah.
And that's sort of say you gotta realize those things, and you gotta understand that. To where like, I'm very happy we had those experiences, because it's like, hey, I just know I'm going to start looking at doing staging again. I know I need to like really tighten up the constructions. Like, I need to hire in nicer stuff for landscaping, the kitchens, the bathrooms. You need to make those areas pop. You need to do other things to stand out on your competition, because you have competition now. Buyers have options. Like our price point, we just listed one a couple weeks ago. Was it? I don't know, 2-3 weeks ago, and we still had all kinds of showings, and we had all kinds of offers, but we had several buyers, which is the weirdest thing. They contract and then fell out like the next day because they got scared of the payment. And I was like, okay, odd, but whatever. You didn't understand what your payment was going to be before you got into it, but whatever. So they back out. New one comes in. Talk to them, interview them. Do they understand the payment? Do they understand the price? Have they lost some house? Why do they like this house? Asking questions about this house. And they're like, oh no, they love it. They love it. They love it. Accept the offer. Monday morning, they back out. What happened? I guess they just got cold feet. The agent's like, I don't know. They're super excited. And all of a sudden, like, they're just like scared. I'll go on to the third offer. It's like, so it just went down the line. It was the weirdest thing. And we had a fourth one that then didn't realize that. I don't know why the agent didn't pre-qualify this person. But yeah, they did. They ended up like not liking it. But main point is buyers have options now. They like this house and they're like, ooh, second thought, I want to go look at some other houses. And there was another guy that said, hey, sight unseen, we want to put in an offer. But then when they went saw the house, they're like, oh, never mind. We didn't like it as much as we thought we were going to. And they went and contracted a different house 2 days later, which is very uncommon compared to 6 months ago.
Yeah.
6 months ago, last summer, a year ago, they were like, man, you take this house, and if you get an accepted offer, you better be happy you get an accepted offer. You're going to have FHA, VA, like all of these were FHA and VA offers. Like, that's going to be very common, but that was also very common back in 2018 and 19 when we were doing this stuff.
Yeah. So that ties into this next article that I wanted to cover. This one is home inventory soars at record rate with U.S. buyers pulling back. So the number of active listings nationwide jumped 31% from a year earlier, a record high increase for third straight month, according to Realtor.com. This year's jump in mortgage costs has sidelined many would-be buyers, and the decline in demand is leaving more homes on the market. Sellers are responding by trimming their prices to compete, a potential bit of good news for shoppers still in the hunt. Inventory has yet to return to pre-pandemic levels, and even as option increases, competition for homes remains strong. Keeping prices elevated, the nationwide median list price in July was $450,000, up 17% from a year ago, and close to an all-time high reached in June. The affordability crunch and remote work policies have been pushing some people to relocate to less expensive cities. So this ties into what we talk about all the time, is affordability. People are seeking affordability, especially the first buyer that backed out. The one thing that blew my mind was this house. What was the sell price on the house that we put up?
220.
220. And their mortgage?
It's gonna be like they said, like $2,400.
That's insane.
Yeah, that blew me away. And like somebody mentioned this the other day. It's like, it's still more affordable to buy a house than rent. I'm like,
No.
What market you in? But like, it was somebody who mentioned it. Oh, it was they were investing in Indianapolis, and I was like, when's the last time you look at the rents and look at the mortgage payments? Like,
Yeah.
it's been more affordable to rent for quite some time.
Well, what was the interest rate that they had? Because it was an FHA loan.
I think it was like 6%.
That-
It was like 5.5, 6%.
Yeah. So that's the problem, that you look at it. We're selling at an affordable price. The problem is interest rates have gone up so much that people that are in those lower tiers, that are lower income, they can't at 2,400 in that neighborhood. I ran the rents. They're not 2,400.
No, they're like freaking like 1,600.
Exactly.
Or something like that.
For
Like,
$1,600, you can rent that house versus spending $2,400 to buy the house. So you look at those things, and you're buying an FHA. So you got your PMI, which is your mortgage insurance. That's going to be an extra couple $100.
that's
Like,
factored into the.
yeah, but that's what I'm saying.
Yeah.
Like, you have a lot of extra expenses that are associated with that. That when you think about it, and then taxes and everything that are going to keep going up as they keep adjusting values.
Where it's like I always said, like 2024 is like, I think that's when it's going to be very hard for a lot of people, because those tax increases are going to start hitting those payments, those style of buyers,
Yeah.
those people that bought the last couple of years, it stretched themselves to the max.
And these are the times that, as an investor, this is the time why we are investing in our education, and why you should too. Try to find a coach that has or is where you want to be. Try to find education, get educated, because the next coming years, these are going to be a tremendous amount of opportunities that are going to hit the market from people that bought now at high interest rates, all of this, and their taxes are due, and now all of a sudden they can't even afford their monthly payment. These are people that foreclosures might start going up, or we'll probably start seeing short sales come back again.
That's where I see more short sales, because everyone's
Yeah.
like, oh, sub twos. Like, no, sub twos are
Yeah.
going to be trash. It's like the payments are so damn high, they boom so much that, like, on FHA, maybe in some conventional stuff where somebody put big down payments, but from my experience, it's like people that put down big down payments bought more expensive houses that have always never rented where they're supposed to be, like
Yeah.
rented for what their payments are and stuff like that. Like, those are usually like higher end, nicer homes. I kind of chuckled a little bit when you say we're selling at an affordable price at $220,000. It's like, that's all relative to, and like I kind of say that that's almost an opinion of what is affordable. Because I remember one gentleman
Well, I'm
saying,
talking
like,
about, because you have median price.
yeah,
Even
yeah,
median
that's what
price
I'm
in the whole U.S. is $450. Median
That's-
price in San Antonio is $340. You said
330.
$330. So we're at $220. Like,
Yeah, it's just like, it's all relative to, like, yeah, that's why I had to say it's like, it's almost an opinion. Because I remember somebody saying, like, affordable price is like $150. It's like, you look at the house you get for $150.
exactly.
It's like, those things have all changed. But one thing I've said, and like we were talking about, people like, oh, I'm just gonna wait and sit on the sideline. It's something like that. Like, you know what? Like, I am glad, happy for those things, because, like, and I mentioned several times in the market updates, like, markets going up like this cannot continue to go up like this,
Yeah.
because it brings in so much speculation. It brings in so many people that don't know what they're doing, that damage the overall market. And that's what I was worried about, is once enough people start getting hurt and raising enough noise, politicians get involved. Politicians get involved and start creating laws, rules, and regulations that make the market even worse. I mean, just look at healthcare in this country, and like a prime example of that. Anytime the government gets involved trying to solve something, wind up making it worse for a lot of people.
Yeah.
So it makes it a lot harder.
Well,
So
and that's why, like, to your point earlier, right now we're getting back to what we consider to be a more normal market. So you buying a house and doing a half-assed rehab on it and putting it on the market and getting full price offers, those days are gone. Like, we're not seeing that anymore. You got to put a quality rehab on the market because of this situation. You're starting to see people that, with these high mortgage rates, we had this discussion before of people that were getting pissed, again, on social media, mostly on TikTok. They were getting pissed because we
TikTok.
said that, nobody cares about the price. They care about the payment. And everybody's like, oh, that's bullshit. Everybody cares about the price.
my favorite one.
No, when you go shopping for a house or even a car, what is the thing that you care about? Can you afford the monthly payment? If you can afford the monthly payment, that's going to tell you what you're going to be able to afford to buy.
Yeah.
You understand? That's what it goes off of. It doesn't go off of you going and saying, no, I want a $250,000 house and I don't care what the payment is. No, it doesn't work that way. If you can't afford the monthly payment, you're not going to get a $250,000 house. And if you can afford the monthly payment of a $350,000 house, you're going to go for that one. So again, it goes back on the monthly payment. So right now, what are we seeing is that people's monthly payments have shot through the roof. So now, what somebody last year could afford, a $350,000, $400,000 home, now they're having to buy, if they still want to buy, a $250,000 home or less, so they can still afford that same monthly payment.
Housing quality and style of housing. That's where I looked at, like, hey,
Drastically
what's
different.
really happened? Like, you think about the psychology of people that were trying to buy in January, February, and March of this year.
Yeah.
Before interest rates went from 4 to 6 in a matter of 2 months. It was a very, very competitive market. I mean, people were getting outbid. There's like, we put offers, agents calling, we put offers in on 7 houses. We've lost out all of them, going over asking price, all those things, like stretching their budgets to the max, try buy a house. And that kept going. So the depressing, and they're looking at $350,000 houses, $300,000 houses. They're looking at them. All of a sudden, interest rates starts rising. Well, when the interest rates are rising, your income wasn't rising. What you could afford was going down and down and down and down and down. So they're getting beat out and beat up and looking at 300,000, falling in love with $300,000 houses. All of a sudden, like, Mr. Realtor, lender, come to you and say, we got to start looking at $250,000 houses. All right, let's go look at 250,000. Change, whatever. 6 months, or not 6 months, like 3-4 weeks later, we can't look at $300,000 or $250,000 houses. We got to start looking at $200,000 houses.
Yep.
Payments have gone down. Huge difference in style of housing, size, lot, location, everything. So now, not where you like, I want to be in this area because I can afford in this area. Now it's like, no, you got to go way over here on the other side of town, and your housing quality, size, age, everything just went through the floor. Everyone's like, I'm throwing my hands up, I'm done.
Yeah, I mean, right now we wholesaled the property that was, I don't even know if it even hit 1,000 square feet. Small little tiny home. The house was, it was fugly. It was in a decent area, but it was old home, everything. In that house, renovated, retailed for 140, 150. Like, that house, pre-pandemic, we wouldn't have even looked at because it wasn't even crossing the $100,000 value in that area. And now they're worth 140, 150. And I'm like, my goodness. So then even at 150 with the mortgage payments with interest rates as they are, like, most people that are, FHA and stuff like that, like, you're kind of looking in those levels and you're looking in those neighborhoods. And like, to your point, when they last few months or last 6 months that they were shopping around a much nicer neighborhood, much higher price point.
Well, it's also like, if you're FHA, like, I'd be shocked to see what, like, can you even afford, or can the house even qualify for an FHA loan at $150,000 price point anymore? Like, I'm sure there are some out there, but I think the majority of houses, because they're much, 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 much older, like, they have a lot of old wiring, old wood, things like that. Like, it's like, the houses just don't qualify.
Yeah.
And that's where, like we say, like, there's a whole nother market of real estate investing when it comes to owner finance, originating notes and things like, which is where that house went to, as a buyer that's going to do just that, originate a mortgage for a house that they can't get conventional mortgages, and go from there, creating it. So, and then they just create paper, and then they trade and sell that paper.
Well, and then here's another interesting article.
Well, before you even change, like, one thing, this article they put in here is the number of active nationwide jumped 31%. Like,
yeah.
You also have, like, percentages. How do I say it? The relative to what you're comparing it to. Did it go up 31%? Yeah. From 1 to 1.3 is a 31% increase.
And
now,
it's also from a year ago when there was no inventory.
Well, that's what I said. When there's no inventory, went up 31% from, I think, Austin, for some of the stuff. I mean, they were at 0.7 months of inventory. Like, absolutely insane, abysmal inventory, nothing to choose from. So 31% from there doesn't even get you to 1 month of inventory.
Right.
So you have to keep those things in mind when you're looking at percentages. You're looking at things like, what percentage of what are you comparing it to? Now, if we were at 5 months of inventory and it went up 31%, that's at 6.5 now. That is a big jump, because that's a lot of inventory.
Yeah.
It doesn't take much inventory to go up 31% when you're starting at 0.7.
Yep.
To get to 1 month of inventory. It takes a lot of inventory to go from 7 to, or from 5, 5 to 6.5. It's like, that is something you got to keep in mind. And why I always say, like, where's the prices going up, where's the inventory going up the most, and say like, I was thinking about this today. Would you rather make real estate's pretty simple? You make about 10-15% on net profit over cost and everything like that of the sales price. Would you rather make 10-15% on 200,000, or would you rather make 10-15% on 600,000?
Yeah,
percentage is the same, but your lifestyle is way different off of flipping $200,000 house for 10% and getting 20 grand versus 10% on 600 getting 60 grand. That's why like real estate people, like they like to do the bigger, nicer stuff. Well, it also goes backwards too when you look at payment. When payments go up, because like when I've said it before, when interest rates spike 1%, it's a 12% increase on the mortgage payment. That's a fact. That's just basic math. Would you rather have a 12% increase on a $200,000 payment or a $600,000 payment? It's not dollar for dollar, it's percent for percent. So it might go up $200 here, but it went up $700 or $800 on a higher price point. So when people see that stuff, it's like, ooh, it really squeezes the top end more. Yeah. So that's where I say, like, where inventory is still strong, it's in that more affordable price point for housing. So you got to be relative, 30%, like, and not look at like, oh my God, it jumped 31%, everything's freaking out. It's like, but you got to see where you're from, where you were coming from, to see, like, really think like, okay, logically, mathematically, where is this to make a thought out business decision?
So if you're watching the replay on this right now, this is these are parts when you rewind, because John talks a little fast, and re-listen to that part, because he dropped a lot of information that is extremely crucial to how you need to look at the market and how you need to invest and how you need to protect yourself. These are things that people don't understand, especially if, let's say, you are investing in higher end homes. If you are doing that kind of, even in rentals and stuff like that, like, that's how those percentages really matter. And then also, like, to his point, 31% inventory increase. People read that and you're like, oh my God, inventory is flooding the market. Is it though? Because it's 31% from last year. Last year we had no inventory. What's the percentage increase from 2019? You understand? Like, I even asked them to, like, on the market updates, I don't know if you could look at it or not, but I was like, can you start going back to 2019, and instead of looking at year over year data, look at 2019 to now data to see, like, because year over year, like, 2020 went to shit. 2021 was an insane year. So you look at these data points and it's like, yeah, 2022 is going to look nuts. 2023 is going to look even crazier because it's normalizing. But when you compare it to what a normal market was before, where are we in relation to that? And when you look at that, we're still in a really hot market, and you are starting to see changes where, as an investor, that's where you need to adjust. As a wholesaler, I mean, we're going to cover some strategies and stuff towards the end, but as a wholesaler, you need to adjust the way you submit offers. It's no longer, let me just, whatever the seller wants, I'll get it on the contract because I'll find some buyer that wants it. That's no longer the case. You actually have to know what you're doing. Crazy enough. But if you are enjoying this, make sure you give us a thumbs up and a subscribe. We really appreciate that. It helps us out a lot. We already got 11 likes so far, so let's get that up there. So I wanted to cover this next article where Blackstone is preparing a record $50 billion vehicle to scoop up real estate bargains during the downturn. So that alone are things that I'm interested in, because if these big companies, these big hedge funds, that they have research teams, right? Because we're our own research team, so we're a very good research team. But they have really deep research teams. They have contacts in Goldman Sachs, J.P. Morgan, analytics. They have access to information, and to put up $50 billion, they're not just like going to Vegas and taking a chance on the market.
Well, also I say, like, more importantly, they say, oh, they have all that stuff, and they do. They also have his political influence.
100%.
To where they look 100%. At it like, hey, it's the too big to fail model. Like, we own enough houses.
Yeah.
And we say, like, we're in trouble and we will dump 2 million houses on the housing market and crash the housing market, which will systemically crash the financial system.
Yeah.
And it's like, well, we can't let that happen. Uncle Sam, let's print more money. to save that. Let's put stuff out there to save that. So like,
And
follow
and
the
they
money,
don't
follow
they
the
don't
politics.
lose. They don't lose because even if, let's say, the government was to say, no, screw you, we're not going to print more money. All right, we'll tank the market. When the market tanks, we'll pick up all those properties at record low prices. We'll still make a killing, but your economy just took a nosedive.
Mm-hmm.
So I mean, yeah, when you look at it that way, and they call me the bad John, and he's over here trying to scare the crap out of people.
It's the way you deliver the information. That's
I'm
what it
sorry,
is.
I'm
You have
too.
you have a permanent scowl.
Yes, I'll do it like you do. So the economy is gonna go to shit.
Oh,
So good luck, guys.
That looks even worse.
Fucking Joker over here. But continuing with the article, right? It says residential real estate is arguably the most valuable and accessible segment of the real estate asset classes. Its popularity has driven its disproportionate amount of capital into residential real estate, particularly from institutional funds, pushing up valuations and pushing yields lower. So, in a regulatory filing last month, Blackstone said it has secured $24 billion of commitments for its latest real estate fund called Blackstone Real Estate Partner X. Combined with Blackstone's real estate funds in Asia and Europe, the company will have over $50 billion available for opportunistic investments. So they are in pretty much like preparing a fund like this. They're preparing for something that's going to happen that's going to make real estate like a hell of an investment for them to get into. Either prices are going to start dropping or inventory is going to soar and there's going to be desperate people selling. I mean, there's going to be something is coming down the line that they're preparing for.
They know a thing or two about investing in single family homes and stuff. Like they were one of the biggest buyers of houses in 2008, 9, 10, 11, 12. I read a book or listened to it. I think it's Steve Schwarzman. He's the one that started, I think, Blackstone or BlackRock, and they spun off in different things. But he talked about what they were doing and like the amount of money they were buying a month across the nation. It was like hundreds of millions of dollars being bought every single month. Like, my God, the power to do that. And like, but the lessons learned on how to do that. Of just saying, like, they were just going to foreclosures, just boom, 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 buying them because they knew the overall market for those price points were going to go through the roof. And where they're going to be buying, they're not buying $900,000 houses, $1 million houses. They're buying entry-level basic housing because there's such a shortage of that. And I honestly blame the municipalities, the politicians, the lobbyists for making it so goddamn hard to build a freaking house.
Oh yeah.
Because after 2008, all the banks got bailed out, but all of these builders got put out of business. So now there's no competition. So they can essentially themselves, your big builders, can control the market because it's so hard to start an entry-level housing production style product. You can't put it out there unless you're building communities of 200 homes, 300 homes, and things like that. And it's just so expensive because like it's just insane. Like we've been through it these last 2 years, 3 years, trying to build a freaking house in a major metro is extremely hard and extremely expensive. Because I think we were like a third of the cost to build a new home is literally in red tape.
Yeah, and before you even start building.
Before you even break ground, a third of the cost of a new home comes just giving it to municipalities, giving it to inspectors, giving it to the cities, and like the fees, the fines, all this other stuff. And because they also want to say, oh, these real estate people are making money, so we'll levy all the fines on them, not realizing like that just makes the situation even worse. Yeah.
So it kind of goes into what we talked about a lot, that in my opinion, I've been saying this for actually years, is that there's no other route for the U.S. to go but to become a renter nation just because of the sheer policies that we've had. Like, you look at, and it keeps shaking out the same freaking way. Because you look at it now, you're having, I was listening to a report this morning about how the first quarter of this year, you had 20-something percent, so I can't remember the percentage, but it was between 20 and 30% of the homes bought in the first quarter were bought by investors of residential real estate. So, and they're saying
it went up that high?
Yeah, they're like, it went up tremendously the first quarter of this year.
First quarter, okay.
Yeah, And so you're looking at these things, and I'm sure a lot of it is these hedge funds and institutional buyers, and we're seeing it. Like, I mean,
I'd be curious to know more about that.
I pulled a buyers list from PropStream just to kind of see who buyers are, who's doing what. And when you pull a list of buyers that own more than 100 homes, you see these hedge funds that are popping up, and in San Antonio, and 1,100 homes, 2,300 homes, like. They don't own a couple hundred. They're owning thousands of homes in San Antonio alone. Like, I was shocked. I was shocked by those numbers.
Man, and it really sucks because I look at that and it's like, and they put out such a terrible product too. Like for rentals.
They don't care.
They don't care. And it's like, oh, they're just driving returns. So like that hole in the wall, that customer service, like it is dog shit.
Yeah.
And like I've heard a lot of people like the rent is $1,900, and like you look at the product and it's like, this is a terrible house. Like, it really is a terrible house.
But they look at the data and they're like, well, what are you going to do?
Yeah, it's exactly. It's like, and you can't make good product.
Yeah.
That's the problem. It's like taxi service sucked. Uber comes along and makes it tremendously better because you can do it like that.
Yeah.
Building a house, putting a product on the market takes months and hundreds of thousands of dollars, red tape, regulatory process. It's like,
and it's not even that people aren't trying. We had a buddy of ours, Austin, that he was telling us how they were trying to manufacture homes off-site, where they would manufacture the panels, they would manufacture everything, so they can bring down the cost, and then they pretty much ship it to you, and you kind of put it together like a Lego, right? So cuts down costs, it cuts down labor, cuts down a lot of things.
No, it's like the cities go like, city inspectors are going to go, I can't see the plumbing.
Yep.
I can't see this. I can't see that. We won't allow it in our city. And this is what I talked about, like inventory getting this goddamn low brings this crap into the market, and they corner a market.
Yeah.
And then now they can control it, and that is what will bring in regulation around these things, and they always overstep saying, oh, you can't do X number of houses until you do here. The big money will figure it out. If the returns are there, they will make it happen for themselves. Who's going to get hurt is your middle and lower tier investors that make it much more difficult to invest and buy houses. And that's where it's like, I am glad that the market is slowing down. And if it slowed down to the point where things were getting negative, I'd be happy with that. But I really, really worry that that's what's going to happen is they own too much inventory. They have too much political influence. They have way too much money and power, and they are going to corner the market for themselves.
Yeah.
And they won't allow a new product to come on the market because it's like, oh, the house isn't safe. Just like we're dealing with one of these freaking rental property that like now I have to rebuild a freaking electric meter on a house that worked just fine before because regulatory red process. So now we had to spend $3,000 extra just to put a rental property back on the market.
And please don't misunderstand. Like, we're not saying that you shouldn't put out a safe product and you shouldn't build a house correctly. You 100% should, and you must put out a good product. The problem is that that's not what they're holding up. Like, the majority of the holdup with all of our new construction has been before we even broke ground on these properties, before we even poured the foundation. Like, it wasn't even that, oh, they're holding you up now because of the plumbing, because you did this wrong or that wrong. That, to me, is acceptable. It's like, you should make sure that the house is built correctly because people are going to live there. But it's not even that part. All the stuff they hold you up on, it's arbitrary politics that you're like, what the hell are you guys looking at?
It's a politic, but it's a money grab too. So here's a prime example.
Ask for the money then. Don't delay the project. How much do you need? And then they get offended.
Yeah. So here's a prime example. When they build a new house, you have to do something in the air conditioner now called a fresh air duct. That goes to the outside of the house because modern day houses are built so airtight that they don't have air seepage from the outside, and the air quality went down. They realized like, hey, we need to have fresh air come into the building. Okay, fine. I understand that. When I renovate a house built in 1940 and add air conditioning to it, I have to add a fresh air duct.
They're not, and they're not built the same as these new houses.
The reason you have to do with a new house is because of all the ceiling, all the windows, all the things airtight because it was built airtight. When I renovated
the moisture barriers around
when I renovate something in 1950, the soffit's different, the roof's different, everything is different in that house.
Yeah.
There's plenty of fresh air moving into the house because the structure of the house really hasn't changed.
Yeah.
But I have to spend an extra $1,000 to put a fresh air duct in that house because that's current code.
Yeah.
It's like,
Oh,
you
yeah.
serious? And it's like, you add all those things in now. That's time, that's money, that's inspections, all that stuff that now has to be charged more and passed on to the end consumer. It's like, and those are the things that it's like, that's the crap that worries me, that makes it very hard to build when you have things like that make it so costly. Like, I renovate a house, I got to get a rent. I got to get a rent of $2,000. Otherwise, this isn't worth it. Hedge fund buys it, doesn't do that, band-aids the hell out of the thing, and still charges $1,950 for the house.
Yeah. No, and it's one of those things that you look at it and you say, like, you're making it not just harder for investors to put out good products and to, take these dilapidated homes and bring them up to current standards, to what they need to be so a family can move in. So now it adds more to the cost. So then the seller is having to take a much lower offer for their home because it's either, well, we got to pay you less for your home because we have all these extra expenses. But if you, as the seller, try to do this yourself, it's going to cost you 3 to 4 times more than it's going to cost us because you don't have our contractors. You don't know how to source the materials that we do. You're going to hire somebody off of Google or somebody that's more of a homeowner contractor. It's going to cost you a small fortune. So you either spend the small fortune and lose anyway because by the time you sell the house, you're barely going to get that money back, or you stay in this house that's just falling apart all around you, right? It's like all of these regulations, like that's what I find interesting, that they always keep saying, we got to protect the end consumer. You're not, though, because you can't protect the end consumer. You understand? Like, by doing these things, that it's such a blanket policy, it's like, I understand it's got to be difficult. It's got to be hard to come out with a policy that's like, this only affects certain things. But I'm sorry, like, don't go into politics if you're afraid of doing hard work. I don't know what to tell you. Like, I don't care if it's not easy. You still have to think about, like, this does not make sense. Like, when we built that house and they wanted us essentially to move the slab 5 feet over because it was pre-built already, too close to the property line, on Clear Lake. So it's like, guys, I'm not moving the slab that was already there.
Well, and then it made logical sense. Like, and we didn't have to move the slab because we're all like, yeah, that's stupid. Why would you do that? The problem was it took us 3 months and $1,000 to get that logical thing to everybody to go through the political process for that issue. $1,000 in 3 months. Where do you think that money went to when we sold that house? And consumer paid for it because it's like, luckily, as long as the market can bear it. So luckily the market did what it did and it worked out for us. But it's things like that. It's like, really, perfectly good slab. Like, why do you have to, now I have to go to this board of adjusters where I have to get 9 of 11 people to agree? Like, and one of them didn't show up. It was just one of those, like, this process of like, why would you have to do something like that for this scenario? This is how it works. Like,
for who?
All right, whatever.
This is how it works for who?
Yeah.
And how many times have we talked about it, that you have how many departments, even just in San Antonio alone, that all affect the housing market, and they don't even communicate with each other. They have contrarian rules that their own rules affect the rules of the other department for the same property.
Yeah.
That's like, guys, do you guys not talk? Like, when you're coming up with these things, do you not think, hey, let me reach out to this other department to make sure that we're not...
Well, the thing is, it's going to be very interesting to see. Like, we have a close friend of ours that's building a house in a county. No jurisdiction at all. They don't have to have any inspections.
Nice.
So they just have to adhere to building codes. And he's like, so I was like, how are you going to verify? I was like, oh, we're going to hire third-party inspectors to go out and verify a few things for our safety. Because, like, I don't know if they're going to cut corners. So I want to have somebody else go in and say, did they cut corners or not? Because they can go in. They don't have to do that stuff. They don't have to have an outlet every so many feet. They don't have to have that fresh air duct for something like that. They don't have to do all of that stuff so they can keep their costs down. It's like, I don't want to have that. So they don't have to put it, because there's no inspector that's going to come and say that's against the city's adopted codes for building standards. You get to choose then. So that's why, like, you have more counties housing being built outside of city limits to get away. That's why a lot of the houses we buy, we look at, like, how do they just have the plywood and then immediately the insulation and sheetrock? Well, because back when Ray Ellison was building homes here, he built in the county specifically for that reason, because he didn't have to listen to the city's bullshit.
Yeah. 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 And I mean, you're going to have to do it. And it's going to be the way to find now more affordable housing is you're going to have to be leaving the cities, because that's where builders are going to be able to build where it makes sense. If not, you're going to stay in the cities, and home prices, I believe, are going to still keep going up because you still have demand that's not slowing down. I had a little article here that it was
Well, it's a demand. You're right. Demand isn't slowing down. The problem is prices aren't slowing down.
right.
So you have a lot of people getting priced out. So another thing I've been looking at, I found very interesting when I was running the market updates information of looking at the permits. Single family housing permits are dropping. Multifamily 5+ commercial units is skyrocketing.
Yeah.
I mean, we're like,
Rents are nation.
What is it? Houston, I think they had some like 300% increase in multifamily unit permits year over year.
Yeah.
And where it's like, where's the housing going to come from? It's going to come from apartments. Like you have like, I mean, where you grew up, like New York, like if you get into the city, like it's all apartments.
Yeah.
Like unless you're super rich, you don't own anything. It's like you rent.
Yeah.
And that's where we're going to become, is like you said, renter nation for your middle class and below. It's like your only option is you just have to rent.
That's it.
And that's where rent control stuff's going to come in. That's where all this stuff, like those controls, and like it's regulation on top of regulation on top of regulation. And it's like, what do you do to fix it? It's like, you don't. Like it's how nations and policies progress. Until something drastic happens, like terrible stuff, like reset everything, you build on top of these things. It's very odd that something deregulates an entire industry like that. It has happened, but.
And that's why when, like, people are saying, prices need to come down. Prices need to drop. Like, why? Oh, because it's unaffordable. Your mortgage is unaffordable. You understand? Like, prices, let's say home prices drop, but interest rates keep going up. It's still going to be unaffordable. It doesn't matter how much it drops. So it's going to be one of those things that's like, what gives? Your income needs to go drastically higher. Interest rates would need to drop, but then home prices are going to go up. We talked about this before plenty of times. We still have a supply issue. We still, like, this past year was the first year that home builders actually crossed 1 million properties building in a year, or a million home starts. Doesn't mean that they were finished, but 1 million home starts in a year, which is what we should have been for the last decade doing consistently, which we weren't. So you're looking at this, that's like inventory is still, like, they were coming back on the market, but not at the pace that makes sense. And then I read this article how Americans earning $200,000 or more are flocking to these top 10 states. So you're having people that are earning over 200 grand moving. The number one state was Florida, and then Texas, Arizona, North Carolina. So when you say prices need to come down in Texas, when somebody that's making over 200 grand moves to Texas, these houses are a hell of a deal for them. You know what I mean? Because they're coming from the coastal cities. They're coming from California, New York, where over there, $200,000 salary doesn't get you anywhere.
Yeah, your entry level housing.
Yeah,
at that point.
But in Texas, you're making $200,000 a year. You're gonna buy a pretty decent home for yourself.
Yeah, you really can, and that's where you see those things, and that's why they like. Where are people moving? What jobs are going there? Because you always ask, like, yeah, but what jobs are coming? What jobs are coming here? But now it's like, it doesn't matter what job is coming here. It's who's coming here with what salary. Because your job could be literally anywhere now.
Yeah, the work
and
from
you can
home
work
and all
from
that.
home stuff like that. To where, yes, you still need to understand the jobs are coming here, but now it's becoming also, you have to look at who's moving here with what salaries.
Mm-hmm.
And stuff like that. The only thing that sucks about those data points is they are so old by the time that information comes out, because a lot of it is dependent on like IRS information, and somebody's got to go dig through the IRS website. And if you've ever looked at a government website, My God.
It hurts your brain every time I try to go into like Freddie Mac and then look at their websites to get the data. I'm like,
Yeah, it's like, what are
I'm
we
like
running on
10 minutes in, and I felt like I've been doing research for 3
It's
hours.
like,
I'm
what are we
like,
still
oh,
operating on 1995 or Windows 95 over there?
oh
Like,
man,
good
like just it
Lord.
hurts my eyes to look at the
That's
data. I'm
just
like, come on, guys.
I wish
And
government
I
ran
think
like
they do it
capitalism.
on purpose though, because it's like we don't want pretty charts for you to see how shitty things are. You know, it's like we
That's
want you
their
to read
purpose.
through the data.
So that was their purpose, not the fact that like the government process of getting money to
They
change
don't
that
even
stuff
use
is like,
they don't even use prices like numbers like $100,000. They'll write out $100,000 in words. That way it gets blurred into the whole paragraph. So
yeah,
it's
they
like
lay over each other because there's not enough room.
in very
Yeah.
fine text, and you're like, I don't
Yeah.
understand what I'm reading here.
Oh my God. Yeah.
But yeah, I mean, it goes back to the same thing, guys. It's education. You gotta educate yourself. You gotta invest in yourself. This is the time to do it. I do believe that the coming years are gonna be rough. They're gonna be very rough for a lot of people that are not taking the appropriate actions now. That you maybe are making good money, you're doing good deals, you're getting paid, and if you're not taking the adequate actions, and all you're doing is buying that new car you always wanted or taking that vacation you always wanted, it's like, I get it. You want to travel and you feel you deserve it and all that. And it's like, okay, but still try to prepare first. And then if you have leftovers, go do what you got to do, right? Hire the right coaches, hire the right mentors, take the right education, look at the market, build your resources, build your network, build your connections. Like that's the one thing that John and I have done since we started. We build relationships and connections with literally everybody and anybody in real estate that is doing something different than what we're doing, something the same that we're doing it, but better, whatever it is. Because if the market shifts, like we said before, people are still going to be buying houses. People are still going to be renting houses. People are going to be still investing in real estate. It's not going to change. It's just going to be harder. It's going to shift who's doing what. And knowing these people is what's going to get you to be able to invest, is partnering with them, is working with them, is tapping into their resources, their knowledge, saying like, hey, you know, I see the market tanked and what we're doing is not working. What you're doing seems to be working. Can we help you anywhere? Can we do something? You know, we have great marketing channels. Can we do some marketing for you? Can we, you know, whatever it is, we open ourselves up to more opportunities. So make sure you're taking that into consideration. And again, if you're enjoying the content, make sure you give us a thumbs up and subscribe. Oh, also, you can join our text community where you can text us one-on-one, ask us any questions anytime if you're having issues with a deal or anything like that. So you can text YouTube to 210-794-9898. And you can reach us at any time. We do also certain videos and content and stuff that's just for that community. We don't put it out anywhere else. So make sure you join that community and ask us your questions and whatever issues you guys are having. So I had this other article that I wanted to cover real quick of Zillow home values and their sales forecast. So Zillow home value forecast predicts a sharp slowdown in annual home value growth for the current pace of 19.8% to 7.8% growth through June of 2023. Expectations for the year ahead have been revised down from Zillow's previous forecast of 9.7% growth in the year ending 2023. The new forecast predicts a steeper drop in appreciation before stabilizing at levels closer to pre-pandemic level. So their prediction is that inflation is going to drop to 7.8 by June of 2023. That is still 7.8 appreciation. That is still home prices going up.
Okay, it's also thinking like at 7.8 that it's all relative to the price thing I'm talking about. That means you buy a house for $200,000, don't do a damn thing to it, and then hold on to it for 2 years. Your home value just went up. Was that 14%?
Yep.
So you're now selling into like the 230s without doing a goddamn thing.
Yep.
Like that's still way too hot.
Yeah. Yeah, because home prices are going to still keep going up. And what you discussed earlier about taxes being an issue for people, it's going to keep being an issue. Because if home values keep going up, your taxes are going to keep needing to get revised, you know, and they're going to be going up. So if you can barely afford your mortgage payment now, you're sure as hell not going to afford it when those taxes go up, unless your income went up. So, and this is coming from Zillow and their data and all their resources. I mean, Zillow, yes, never trust a Zestimate, right? But it's I have a friend, a buddy of ours, Tim Allums, that he has a mug that says the A in Zillow stands for accuracy. So,
Oh yeah,
for those of you that don't catch that, Zillow in their name doesn't have an A. So their estimates are definitely never accurate, but they do have housing data and all of that. I mean, they supply, they have all the properties, all the information. So them saying that it's adjusting and it's still going to have a 7.8 growth by the end of 2023, like, guys, that's still inflation. That it's still prices going up. And that's their adjusted forecast. So those are things that you got to consider when you're thinking about, well, I'm just going to wait to buy, or I'm just going to hold on until the market crashes, or this happens or that happens. It's like, do you know that that's going to happen? What are your facts on that? And one point that like you made that what our coach was talking about, even in a crashing market, you still can flip houses. You just buy them lower and sell them lower, right? So you're still following the market down. You don't, it's not just because home prices are dropping that you can't buy properties. You can still buy properties. You can still do flips. It's just you got to be more conservative with the flips you do.
You got to watch it.
Yeah.
So Brian Pauling reached out and said that did Zillow and Opendoor merge? I heard about this, but it's like they didn't merge. So if anybody's ever gone, like say you're looking at a car, and you go on to, what's it, Kelley Blue Book or something like that, and you get on there and they have on there, what's my instant offer for the house? They have that instant offer feature of it.
Yep.
That is what now Zillow and Opendoor are doing. So if you're like a home seller on Zillow trying to go in there and sell your home via Zillow, you can now say, oh, instead, it's just like what they used to do with when Zillow had their instant cash offer piece. Like, what would Zillow buy my house for today?
Yeah.
Opendoor now has that ability with Zillow. So Zillow basically said, we're not going to do this stuff because we're going to lose tons of money doing this, but we'll allow Opendoor to pay us so we can market their properties and do that.
Yeah, so
that's basically
Zillow
what it is.
did try to do it,
well,
and
they did.
failed.
Well, they did. They just said that they were a big iBuyer. They were trying to compete, and they realized like, hey, we can't. This is not profitable for us. We are not going to do this. We're losing too much money. We're going to drop it. Yep. And then they just did a partnership with Opendoor since they already had that capability, and now they're just profiting from that and saying like, Opendoor, you can pay us to be on our platform, and you can receive instant cash offers from Zillow. So that's what they did. Brian, to answer your question, they didn't merge. They just have a partnership around that.
And Opendoor recently got a little slap on the wrist.
That's what I was just getting ready to put on here. And it's like, and it's no surprise either. It's like, and I was actually happy to see this because of these iBuyers. Like you look, we've come up against them several times, and like Opendoor, like, oh, we'll buy this house. Like, oh, they're willing to pay like really almost like retail price. Yeah, that's their initial offer. And then they're going to come do inspection and beat you down. Then they're going to tag this fee and go down. Then they're going to go down and say, oh, our selling fee is 5% more. And when it comes down to it, it's like, yeah, they just got you and then they scammed you into this thing and deceitfully marketed to you. And that's what they got hit with. So the FTC came out last week and said took action against online home buying firm Opendoor Labs Inc. for cheating potential home sellers by tricking them into thinking that they could make more money selling their home to Opendoor than to the open market using the traditional sales process. The FTC alleged that Opendoor pitched potential sellers using misleading and deceptive information, and in reality, most people who sold to Opendoor made thousands less than they would have made selling their homes using the traditional process. Under proposed administrative order, Opendoor will have to pay $62 million to stop its deceptive tactics. Opendoor's marketing materials included charts comparing the consumer's net proceeds from selling to Opendoor versus on the market. Those charts almost always showed the consumer would make thousands of dollars more by selling to Opendoor. In fact, the complaint states the vast majority of consumers who sold to Opendoor actually lost thousands of dollars compared with selling on the traditional market because the company's offers have been below market value on average, and it costs have been higher than what consumers typically pay when using a traditional realtor. And this is my comment to you. When you say the government never does anything good. It's like oh, these people should have learned their lesson and compared things. It's like, well, when you have deceptive trade practices come in here and hurting people by using slick sales and fancy charts and doing it, it's like, that is the point of a government agency to step in and just be like, the way you're going about it is damaging, hurting a lot of people just to make yourself more money.
So I agree. That being said, they didn't do shit. All they did was what they did do. The fine is nothing. $62 million. I mean, they'll find other stupid investors like they've been doing and raise another round of funding to keep funding their Ponzi scheme. But what they did do is bring more awareness to the public of Opendoor's tactics. So when we deal with sellers and they tell me, oh, we got an offer from Opendoor, all we do is educate them. We're like, understand that offer they're giving you is not what you're actually going to walk away with. You understand? They have a lot of hidden fees. They have a lot of other shit that they go through. And you're going to be getting much lower than what you think you're going to get. And we never try to tell our sellers like what they're saying that, oh, selling to us, you're going to get the same or more than what you do on the market. Bullshit. We always tell sellers, look, if you want retail, if you want full price, you should list it on the market. You understand? You list it and you go on the market and you're going to get full retail. But why do you want to sell to an investor? Because maybe you need to sell fast. Maybe your house needs a lot of work. Maybe all the things that we've gone through, people don't want to deal with agents, people coming through their home, having to clean up their house, having to show it so many times, deal with appraisers, deal with inspections. So if you don't want to deal with those things, then you're going to pay for the convenience of selling to an investor that's not going to do any of that. Yeah. That's not going to do an inspection. They're not going to do an appraisal. It's not going to be with any contingencies or concessions or anything like that. They're going to come in, give you an offer if you're dealing with a good investor, give you an offer, and whatever that offer is, that's actually what you get and what you're going to walk away with. So it's like, we don't lie. There's nothing hidden. If we say you're going to walk away with $130,000, we put it in the contract that you're walking away with $130,000. Of course, if you have a mortgage and stuff like that, that gets deducted. Like, we're not paying you that on top of your mortgage. It's an all-in price. But you know what you're getting from day one. We don't close if you don't know, if you're not comfortable with the terms. But Opendoor wasn't doing that. And we knew that. I mean, we've been talking bad about Opendoor
we've seen their offer several times, and it's just one of the things like, is there a place for an Opendoor? For sure. When you say those things that you just said, it's like, but it's also like, I don't see how they're profitable doing that. Oh, their thing is like, they lose money on the house, but they've scaled to where they make money off of providing other services.
Yeah.
That's what they do. But I'm looking at their stock. And since they opened, they're down 45% from their opening, and they're down year to date, they're down 60%. Or it's just like, I would love to see them crash and burn for what they do, how they've done it, because I do think they do provide a very manipulated, deceptive process, trying to make profit off of that stuff. And now they just moved their headquarters to San Francisco, so they're like a tech company trying to just bombard people to get houses. I mean, it's just kind of the same we were talking about earlier, like big investors buying houses that could have sold to the retail market.
Yeah.
It's like, that's what they're taking off the market, because there is not enough competition for building of standard homes. There's a lot of custom home builders that build at the higher price point of, here in Texas, 500,000 and up and stuff like that. And you have some big builders doing that too, but your entry level house point that people need to get into, that you say your median household income of $55,000, $60,000 cannot afford a house.
Yeah.
Because those people cannot build cheap enough, and the houses that are for sale are being bought up and pushing everything up across the market.
So we have a comment here from Alicia. She's our acquisitions manager. And she puts, wouldn't it be up to the consumer to do their homework and know they are lying? We ourselves have had clients tell us they thought about going with Opendoor, but after researching, they will lose money and decided to work with us. So I'm very big on you taking ownership for your life and doing your own research and everything. That being said, that's not the case. That's not the majority of the time. That's not the case. Like, homeowners are homeowners. They're not real estate investors. They're not real estate agents. They don't know what's
Most
going
people
on
are
in the
not
market.
financially savvy at all.
No, especially in those areas, those price points and everything. Like, people are just blue collar workers. Like, they don't know what it is. They just see the convenience. They want to be, they just want this process to be easy. How many times are we dealing with sellers where they are still just so overwhelmed with the process of selling their home? Like,
Yeah.
so overwhelmed. So it's one of those things that's like, you look at it and you say, no, it's understand. That's why one of the things that Alicia does and that we always done in our business is that when we deal with sellers, what we do is not negotiate. We educate. We focus on educating our sellers, like letting them know, like, hey, if you're going to put it on the market, that's fine. Just keep in mind it needs to qualify for financing. If not, it's going to be a cash offer because maybe you have foundation issues. You have an old roof. You have things that are not going to qualify. Yeah. The market is shifted. Like, we give them everything for them to know. So then that way they can make an informed, educated decision. We're not trying to just tell them, like, no, your only option is this. You have other options. It's just, what is it that you need? Oh,
Yeah.
so you need to sell
It's
quickly.
also like they said, like, and what they've done is, like, they did their own research, but the research was tainted. They lied on all of their data. And when you're a big company like that, you get all kinds of publicity. You get paid sponsorships. You get all these other things to come out, like how good it is. You can get all kinds of fake reviews. You can get all kinds of stuff. And like what Brian's putting on there, it's like, it's shocking. It said Opendoor reported loss of $662 million, over double the $253 million lost revenue reported in 2020. The higher loss was driven by stock-based compensation, which ballooned to $536 million compared to $38 million in February.
So how is this not a Ponzi scheme?
Well, that's what I was saying. Like, and it's the whole ordeal of the whole blitz scaling thing. It's just like, let's just see how big we can get. Let's drive stock prices,
Explain blitz scaling.
Blitz scaling is like, you just try to scale at all costs across all platforms. Extremely high stress, but it's all driven off venture capital, Wall Street money of literally just trying to get that next round of funding, like you said. But that is how money works. It's all of that way. It's trying to get to so big and then try to stabilize.
Yeah.
But at some point, it's like also trying to get, like, can we get big enough not to fail?
Yep.
Like, if we hold this many millions of homes in our inventory and the market starts slowing down and crashing, it's like, literally, we have enough inventory that we can crash markets.
Yep.
So you better step in and help us, or we're going to crash markets.
And it's
in the market we're in, and the type of economy we run now, it's like, oh, we can't have that. Yeah. We can't sustain that. Systemic risk, I think Rickards talks about. It's like the systemic risk of how interconnected everything is. Like, we can't let this one market crash, because that market will spread to this market, which spreads to that market, which spreads to that market. And then it damages everything, which now spreads to the financial markets, which spreads to everything. Like, we better print money to keep this.
And this is not to say that at some point down the road, if they stay in business, Opendoor won't be a good company. Like, they could very well turn out to be a great company.
I hope not.
Years down the road.
That's
because, like, they just grew so big. They made all the mistakes. They did everything. And then they kind of stable off into a company that, you can actually do business with and whatever. Or maybe not. But definitely the practices that they're doing now are shady as hell. They're shitty as hell. And it's one of those things that's like, yeah, if the homeowner, if the consumer is not educated and they're not well informed, they're gonna regret selling to Opendoor. They're definitely gonna regret that move. So with that, I wanted to use this last part of the show to kind of cover what we were talking about earlier on strategies and things that we're implementing, things that, how you need to be looking at real estate to prepare for this, whatever comes down the line, and to prepare for the current market. So first off, let's talk about wholesalers. Wholesalers right now, you need to be adjusting your model from, the homeowner wants a certain price, you're contracted because you're going to get a buyer. That's no longer the case. We're seeing wholesalers right now fall out of contract because they contracted way too high. You understand? So what you need to do is find yourself a stable list of buyers that you can count on, you can depend on, like real, actual buyers. And most of these are going to be your buy and hold buyers. Most of the investors that are going to stick out through whatever happens are always going to be your buy and hold buyers. So you need to build yourself a nice list of buy and hold investors that you know what their criterias are, you know where they're looking to buy, what kind of cash flow they want, all the numbers. So then when you're negotiating, you're not wasting sellers' times and you're actually getting properties that you're going to be able to sell. Another thing that we're looking at is the key to getting a lot of deals, it's going to be in the follow-up. You're going to have a lot of wholesalers that don't watch our show, and they are not going to make these moves.
That's why they suck.
And then they're going to, and I'm the bad John.
Like I said, it's all in delivery.
Yeah.
I smile when I give you bad news.
So, okay, I'll smile when I call you stupid.
Your smile's forced.
So it's you look at these wholesalers that they're not adjusting the way they're investing, the way they're making their offers. So we submit our offer and they're saying, "Oh, I got a much higher offer." Okay, we'll follow up. Because when we follow up a month or two from now, that wholesaler couldn't deliver. So now this seller is getting even more desperate, and they're realizing that their home really wasn't worth what that person offered. And they start coming back to us again. It's happened already. People are coming back and they're saying, "Hey, is your offer still good?" You understand? So following up, it's not just, oh, you submit an offer, they declined it, and now you're just stepping out. It's like, all right, well, they didn't want the price or whatever it is. So, this is a dead deal. No, it's not a dead deal. In this market, the chances that somebody's going to be able to close for that much higher than you is going to be very, very low. You understand? So you still have a shot if you hang in there and if you take the time to educate them. Now, on the flipping side, what we talked about earlier, you got to do good renovations. Any renovation that you do, make sure you're doing quality rehab, putting good products in there, putting a good product out on the market. You might have to go back to staging homes, taking really good professional pictures. There's no more of this hoteling stuff. We're seeing less and less on that. Like, you're going to have to take down a house and actually do a good renovation and not cut corners. I wanted to cover real quick that case study pretty much of that investor that reached out to us wanting to sell a package deal of those 3 houses.
No.
And what was the combined value of all 3 houses that they were trying to sell? Was it like 6 and change?
Yeah,
because they were all in the 200s,
so
right?
Like the ARV, like retail fixed up.
What they were listed for? Because they were all listed. Weren't they all listed for like 200 and change?
Yeah, I want to say it was around that or something like that.
So yeah, so
it was like high 5s, low 6s, something like that when you looked at it. But it was listed like they were under market value, but not by much.
Yeah.
And 2 of the 3 had massive foundation problems.
Yep.
Tens of thousands of dollars, including plumbing that would be in there. And they were only listed like 20 grand below what the retail value was when they're fixed up. And when we went,
they were rehabbed. They were
not rehabbed. Okay.
No, they were rehabbed. They weren't properly rehabbed, but they were rehabbed.
It's one of those things, like I even mentioned it to him. I was like, God, I wish when I see things like this, I wish they just wouldn't even have tried to rehab it, because now they want to get a return on their investment, and I can't give them return on investment because I got to redo everything that they just did. It was that bad.
Yeah. And
went and looked at all 3 houses, and I told him, like, dude, we're going to be low. We're going to be low. We're going to be low. And I shot him an offer price. He's like, oh, is that just for those 2 houses? Like, no, that's all 3, bud. Like, every one of these houses needs to be completely redone. Like, it was so shitty of the work that was done. And
yeah, you're talking about 4-inch foundation drops, 5-inch foundation drops. We gotta do all the flooring. That's gonna create massive cracks and everything in the walls. The sheetrock patches and stuff they did were.
Well, when they scraped the popcorn ceiling, they didn't even take it all the way to the edge. So like the entire perimeter of the house still had popcorn that was just painted over.
Yep.
It's like, dude, these like. I got to put out a good product now. Like, the market is not what it was 6 months ago. Yeah. And like Alicia just told me, she's like, oh, they did a price drop of $5 grand. I was like, ooh, they better keep dropping. And like, where 2 of the houses were not nice areas.
No, they weren't
at all. And I just like, dude, I'll give you an offer, but like, I'll give you the offer. Like, I don't want to take this on, but I'll take it on at that price.
Yeah.
Because it goes like, oh, he's ready to offload them. He'll let them go in a package deal. It's like, they're trash houses. Yeah. Completely trash houses.
Yeah, even the cabinets they chose, we had to, all the cabinets needed to be redone. The vanities, I mean, they must have had like a blind guy with a hacksaw cutting the back of the vanity to fit the plumbing. That thing looked like like somebody grabbed it with their teeth. It was like ripping out the back panel of the vanity to fit the plumbing in. Usually you cut nice, clean squares. This thing was splintered, broken, brand new vanities. That's like, you can't even fix this. You got to throw this vanity out, put new vanities in. The tile, the grout job, everything was just.
And it was the type of person that
insane.
Larry Roberts puts in. I suspect those rehabbers will be dropping out of the market soon. And I agree. Yeah. And it's like when you look at the deed records, they were bought in like 2020, 2021 and tried to rent them out for a year, get the cheapest of the cheap contractor to do the work and to make their profit margins bigger. And now they're trying to sell on the open market. And it's like, sorry, bud, the open market's not paying for crap like that anymore.
You're trying to sell retail, but a retail buyer, you're going to get what? FHA, VA. That shit is not going to qualify for financing.
Like, the two houses, like they were like, ugh. And they're like, that is going to be an FHA area, but like you got to have it still look nice. And they both needed foundation issues. Both had plumbing problems. It's like the values were, and that's also something we've started doing is like, we used to run comps on a 6 month back date.
Yeah. Well, I was going to get to that. Yep.
And like we're saying, like, no, there was such a massive market shift in April and May that we're only running 3 month comps now. Because if you try to go back 6 months, it's like, yes, prices were high, but now there's ones that are lower. And everyone has a tendency when they don't understand market and they just try to do things quick and not understand how this business works. They just go, oh, run my comp 6 months back, highest priced homes. I want to do those. Look at the sales price of those. When did that house contract and sell? And 6 months ago, that was February.
Yeah.
So this thing sold in February. What market were we in February? Even February, March, April, May, you were still getting ultra high prices because there was still massive amount of competition. You get low amounts. Mm-hmm. But now you have the problem where interest rates spiked through the roof and inventory went lower. Because when you look at appraisals, when you actually study and not just look at the money, how's an appraisal determined? They look at the most recent house in the closest proximity. So now when you got 4 houses that have sold in June and July, they're not going to use the houses that sold in February, March, and April. Yeah. They're going to take that lower price. So I did that in my analysis and prices dropped. And that's what we base it off of. He's like, he never even responded when I told him it's for all 3 houses. But it's just like, you got to look at it that way. And if you're just a fly-by-night, quick investor looking after the money, a realtor or investor, that's where you're going to get hurt. And I hope you do.
And that's definitely, I think this investor's for sure, definitely a new investor. And he decided to jump on 3 big ass projects all at once because the market was hot. It's like, guys, that's the problem with speculating. When you speculate, the market is going to smack you down. And we were even doing the 3 months of looking at comps even back last year, but we were using it in reverse because we were seeing that in how prices kept going up. So when we were getting ready to price a home to sell, to buy, we are always conservative. We always go for the conservative number. To sell, we don't mind pushing because we know that if anything goes wrong, we have our conservative number that it still makes sense. But we were looking at what's the most active properties. What are we seeing? Are the prices going up? Are people selling for higher? Now we're using that same strategy, but to seeing the complete reverse where houses are dropping. Houses are selling for less. So we're looking at like the most recent solds, the most recent actives, because those are going to be
pending sales.
Yeah.
It's like, I'm calling like, hey, are you guys over asking price? Yes, we're over asking price. How much? Well, they won't tell you. It's like, yeah, but like, can you give me like a range? Are you just like 5, 10, 20? Like knowing where that house is going to close. So like we were having to call and do research above because we go to the highest price sold, use the most recent, and then you have pending ones in there. It's like, I want to see what their offers were accepted at because it's pending, which means they're through option. They put real money into this house now. Yep. It's like the likelihood of that closing. But now you got to go backwards the other direction. And people that have come into this market, it's pulled into this market the last several years, they don't know how to do that.
No.
Or if they were just wholesaling, they don't care. They don't understand that stuff.
Yeah, so it's definitely, as a flipper, as a rehabber, you got to pay attention to those numbers. You got to run your numbers. Look at the comps. Look at the comps definitely in the last 3 months, in the last 2 months, in the last month. Look at those numbers because that's what is going to matter when you put your property on the market. If something, for whatever reason, changes and prices are higher, then great, you made more money. But if they keep dropping, you're going to be stuck in a really bad position. And now for buy and hold. Buy and hold, we are switching our strategy up a little bit where before the last couple of years, we were really pushing rents because we just could. it got to a point where we weren't even running comps for the rents because the comps weren't
Didn't matter.
accurate. Like it was something that you look at the comps, and the comps, if you're watching for the first time, are comparables. You know, what are houses that are comparable to this one renting or selling for? So the comps we were running for rentals, like we would see 1,600, but we would put the house on the market for 1850.
Well, that's just the issue. Like, you can't run comps. There is no place you can run solid rental comps anymore because the process to list something on the MLS is so terrible, and it costs money, takes time. It's worthless. We list everything through Zillow, and all the more non-property manager style people that own property all list through Zillow, and Zillow does not tell you what something rented for.
Yeah.
So you're never gonna know. So it's you just almost have to be in the market and talk to people like, what are you getting? What's happening? But to your point, I think I know where you're going with the rents now. We're switching strategies on that, but I'll let you go with that. But it's very hard to run comps now. So
yeah. And so what we're trying to do now, just because of the uncertainty in the market, the uncertainty with employment, with what's going on with inflation and everything, is we're no longer pushing rents. Like if we feel that the market rent is probably, let's say 1,700, we're not going to go higher than that. We'll probably go a little bit lower than that.
Yeah, we will.
Because what we want to do is find a tenant that's going to be reliable, that no matter what happens, we know they're going to be in that house come 6 months from now, come a year from now. So we're looking at their jobs, at their income, because we started seeing that a lot, even in apartments, that people are getting almost co-signers because they weren't making the 3 times rent. So they're like, all right, you're making 2.5 times rent, but if you have a co-signer, then you can get this apartment. And I'm like, holy shit. Like, this is crazy. You're pretty much saying, like, because they say 3 times rent is what they're looking for, because in theory, with 3 times rent, you should be able to afford your rent and all your other bills. The problem is most Americans have a lot more expenses.
Well, that's the problem.
Than 2/3.
When people focus only on the money.
Yeah.
And it's like, I need to get my returns. I need to drive rents. Rents can do it. Rents can do it. Rents can do it. The only problem is you're going to realize, like, when you start doing that and cutting your criteria, your evictions are going to go up. Yeah. Your delinquencies are going to go up. It's just going to become much harder to rent the house. Your repairs are going to go up because you got less quality tenants. You're going to damage your property more. And it's like, that's the issue you're going to have when you drive. You buy high prices. You want to buy and hold, and you try to push the rents to get even higher. And then the quality person, you're not going to be able to find. So that's what we're doing. It's like we're dropping prices where it might rent for $1,700. We're going to go for $1,600 because one, we bought it at a time where our mortgage is low enough to where we have that margin to drop, and we understand that I get a better tenant in there. I will pre-screen that tenant a lot more to know, like, do you have the cash to float? You're not one car payment away or one breakdown away, flat tire car repair from missing rent.
Yeah.
Yeah, we've done that twice this last year where it's just like, dude, I don't care anymore. Like, I want my rental portfolio to be as hands-off as possible, and that comes from the tenant, not just from the house, because we've already put a good quality product out there. Now I want a quality tenant. Well, I will gladly take $1,200 less over the course of 12 months to get a better tenant.
So we have a little bit. So let me put the final point, and then I want to hit a question that I heard recently. So the final point on this is you made an excellent point there where it's like you should not get into an investment, and the only way it's going to make sense if the market pulls you out, right? That's like, I need to get this price in order for this house to make sense. I need to get a higher rent in order for this rental to make sense. If it doesn't, you make that deal make sense when you buy. If it doesn't make sense when you buy and you're hoping it's going to make sense when you sell, my goodness, are you gambling? Like, you are really hoping for the best there.
McElroy talking about this the other day. He's like, I see so many syndicators out there.
Oh yeah,
only syndicating to get the fees.
Yeah.
He's like, when you look at their numbers,
they have no
like
experience.
With the interest, no, not experience. It's just like with the interest rates and the cap rates and everything. He's like, the deal that their carrying costs won't even let them hit their cap rates. Like, they're doing it for the fees because they get massive acquisition fees, and it's an easy industry to sell and raise money right now.
Yeah.
So it's like, you look at syndicators, and you have to watch that. It's like, are they raising money just to get the fees? Like, because they can make anything look pretty on a spreadsheet. That's easy to do.
Yeah.
But when you look and understand the things that we just mentioned about higher costs, higher rents, higher turnovers, like, those things are very expensive. And then you have vacancies on top of that. Like,
So
I'm sorry, and it's also, you can't really go after a tenant. You can put a judgment against them and stuff like that. Yeah, but good luck from somebody that's
collecting.
renting something like that being able to collect, because they're never going to own an asset you're going to be able to collect
It's
from.
the same when I hear investors say, if this contractor screws me, I'm going to sue them. I'm like, okay, yeah, good luck with that, buddy. Let's see what you're going to get from that contractor. But you brought up Ken McElroy. He has an excellent podcast I recommend everybody check out. Not instead of ours. That's on top of ours. You should check that one out. And but he was talking about what he's seeing, because they do apartment buildings and all that. He holds, like, I don't know, over 10,000 doors, whatever he holds. And one of the trends that he's seeing is that on his 3-2s, 4-2s, all of these, he's getting application for essentially couples that are moving in together, like sets of couples, right? So you're having a guy and his girl and another guy and his girl, or girl, guy, whatever gender.
Stop talking.
Okay,
your story.
So let me move on.
You don't get out.
Brian, start offending. YouTube's gonna shut us
down.
Stop
talking. Go.
Okay.
God.
So they have different, but what I'm trying to get to is that they're not all family, right? They're friends, whatever it is. They're all moving together and pretty much essentially trying to rent out by the room, because that's the only way they're going to be able to afford these rents, these places, these houses. So they are looking for bigger properties, bigger homes that they can move in with multiple people to make it more affordable. So that was very interesting. So as an owner of rental properties, would you allow that on your properties?
100%.
Yep.
It's one of the things, like, I mean, it's hard to do. It's like, what is the status of their relationship? It's like, oh, I don't want them to break up and they move, because some people
you gotta check on Facebook.
Yeah. But I would 100%, because like we've trying to think if we've had somebody like that. I know we've had two friends move in together and both had separate jobs, and
we had that family with the mom, and she was supposed to be getting a job.
Yeah, but I mean, we've had that where it's like multiple people move in with multiple income streams, and like I would definitely do that. It's like, hey, you have two couples moving in, you have 4 incomes there.
Yeah,
it's like, yeah, you can well afford my house to where something goes wrong. You guys are on the leases, and nobody wants the eviction on there, because like that's the biggest thing you can hold over somebody's head is an eviction, because once that hits their record, now anything they go try to rent, they're going to see an eviction.
Yep.
And that's going to be hard to rent something. It's not the money that you're going to recruit, but that eviction is what you can hold over somebody. So all 4 of them do not want an eviction now. If something doesn't work, it's like, hey, you're all on this. You guys need to figure this out. So I would definitely rent to more than one family.
And this goes back to a point, again, if I haven't said it enough, education. Like, listening to these other podcasts, listening to what other people are doing, it's going to give you ideas and things of what other people that maybe have more volume than what you're doing are doing to adjust for these things, and give you ideas on how to manage it, how to run it, how to make it work to your benefit. There's always a way, always a way to make money in any market, but it requires financial education. It requires knowledge to do it. So invest in that, spend time learning, reach out to people in your area that are doing it right, and build those connections, build those networks. So as we wrap up, anything you want to add?
No.
All right. So, well, there you have it, guys. So hope you guys enjoyed this episode of Coffee with the Johns. Please share with your friends, subscribe, give us a thumbs up, show the love, spread the love. It's a lot of work for us to put these together, but we love doing it because our goal is purely to educate and help you guys out, be better investors. It also makes us better investors, and we have a blast doing it. So I hope you guys are enjoying it. Over the next coming weeks, it's going to be a little questionable when we're going to do another Coffee with the Johns, because my wife is expecting any minute now, pretty much. So depending on the baby's schedule, we'll see when the next Coffee with the Johns is going to be. But in the meantime, subscribe to our channel, stay posted. I will be going live throughout the week in the coming weeks, just breaking down these strategies even further, where you can jump on and ask questions specific to those strategies. I'll go into wholesaling, flipping, a lot deeper details, going into marketing. So if you guys have any questions, you'll be able to ask me live and we can cover those things. So if you're interested, make sure you guys subscribe and join our text community. and you'll get notifications
What's
for
that
all
number?
Our text community. Just text YouTube to 210-794-9898. And it's completely free. It's again another resource for you guys and to get some help. So hope you guys all enjoyed it. Thank you for watching, and we'll catch you on the next one.
I was trying to watch like, are we gonna have like drop off? No, drop off when you start posting it out. But also we went like 21. 5. I was like, what the fuck? We had it 25 all show.